Well, good morning. 5 below zero, and where you got a great crowd. So I love South Dakotans. It's just great. We've had snow before. We've had all kinds of issues for this event, and so it's great to just have 5 below. So I want to welcome everybody to the 23rd Annual Market Outlook, hosted by Bender Commercial. And if you don't know, I'm Michael Bender, one of the partners here, and we're pleased to present to you the 23rd Annual Market Outlook. We hope it, as always, it's beneficial to you for decisions going into this year for real estate. And so with that, let's just get right into the slide. We've got a few new faces this year. They've been involved in the research and the analysis the last several years, but you're going to hear from them this year, so you'll recognize them when they get up here. So let's take a look at the first bit of information. This came to me from a friend who's in the audience, Greg LaFollette. And it's a graph that I want to show because I think it shows you it portends what we're going to deal with in the next decade. We're going to talk a little bit about the decade here. And what this is a graph that shows you the rate of inflation, and that's that middle bar right in the middle, about 56% over the last 20 years. And then it shows you industries that have been able to deliver their goods and services below that rate of inflation or at that rate of inflation, and then industries that struggle to deliver their goods and services, and they're sometimes, as you can see, well above that rate of inflation. Now, ironically, the ones that are struggling to deliver those goods and services have either heavy federal subsidies or their payment system is tied to a federal plan. So they're going to have to figure out their plan and how they deliver those services and goods in the next decade, or there's going to be more and more political pressure on those industries. Most notably, you can see higher ed and healthcare delivery. So something to think about as we enter into this decade. In fact, let's look at our decade. And in order to kind of look at the decade forward, I want to look at the decade backwards. And I call it the decade of destruction and of disruption. And there's a little Freudian slip there. So disruption isn't always bad, I might add. There's some areas on there, number one energy producer this last decade, lowest unemployment, highest wage gains we've seen, and certainly the wage gains on the bottom 50% of our economy, the highest wage gains. So there's some positives to disruption, but there's also some negatives that take place. Clearly, there's an anti-global backlash with Brexit, with President Trump being elected. No question that you're going to see erosion of social services more and more. Another example really is on Facebook. I mean, from a technological standpoint, if you think about 10 years ago, who would have thought that Facebook would equal more in value than really those stalwart Dow Jones kind of names that we all know. So there's a lot of disruption out there. I threw Sioux Falls in there because I think it's important to note from a local level, we've seen disruption. It isn't necessarily in that classic sense. I would say what we've seen is risk-taking. The last 10 years, if you think back, we've probably added a little more taxation to our general bond obligations than we should, but we've taken risk, and I think it's paid off. I think that's disruption. We've had a new event center that's widely popular, new indoor swimming, a number of things that we're doing as a community. And so I want to make sure we talk about disruption in that sense, that it's really both positive and negative. On a sports scene, no question, 108 years later, the Chicago Cubs kind of disrupted the sports scene, and by winning yeah, there you go, we got one fan. So, wait till you see my prediction of the sports scene for the next one. So let's fast forward now and say, what's the next decade going to bring us? Yeah, there you go. Probably one fan for that, too. So I would have put the Dallas Cowboys up there, but nobody could care less about the Dallas Cowboys, right? So let's hope that the Vikings win a Super Bowl this next decade. But let's think about this decade. Let's talk about a couple of things in this decade. I mean, we're going to see, in my opinion, we're going to see more and more liberalization of laws. Marijuana is an example. Sports betting is another example. We're going to see it under, in the case of marijuana, probably under social justice reform, under prison reform. The cynic in me says we're going to see it under economics, both from the incarceration side, but also from the tax side. There's going to be a push to get taxes off of everything we can going forward. And that's why you're going to see more and more liberalization of what we consider laws that have been standard. So there's disruption there from a social standpoint. Technology, I think, is one that I want you to think about. You know, the advent of 5G, I had no idea what 5G really means until I started researching it and thinking through what 5G really means, because our mayor has gone to great lengths to already wire, and in fact, this building is 5G acceptable already. So this is one of the buildings in downtown that can handle 5G. So with the advent of 5G and AI, it is going to revolutionize the way we all do business, the way we all live, quite frankly. The Internet of Things is going to be a real discussion this next 10 years. We're going to be connected to every device possible. The 5G is going to revolutionize the way we transport ourselves, the way we conduct our business through blockchain, certainly on the real estate side with the title companies. The way we educate ourselves through 5G is going to change this decade, there's no question. The way we entertain ourselves. So there's going to be a revolution that's going to take place. While it's not fully implemented until the mid-2030s, 2035, they expect it to be fully implemented. I don't know if you realize it, but 5G and the advent and the economic benefits is $12 trillion of additional economic benefit for the U.S. alone. So it is a huge, huge game changer going forward. So think about that and how it impacts real estate, how it impacts your businesses going forward in this decade. Social services, I alluded to that a little bit. I think we're going to see more and more erosion of the safety net that we all have known. So that's going to be disruptive. It's going to create social unrest, quite frankly. And it's going to be at that level of health care, of Social Security. Some of those things, I believe, are going to be very disruptive over the next 10 years. And, you know, another one is really tied to those safety nets is record low interest rates. I think that with $22 trillion in sovereign debt and our obligation to service that debt, I think that's probably going to drive more than anything a record low interest rate environment. There's some downside to that. Asset bubbles, you're going to hear about that from Nick and others. So there's some positives to that record low interest rate, but there's also some potential negatives that could end up with very disruptive forces. So, and then finally, as I mentioned, you know, we'll see if the Vikings can kind of pull something off over the next decade. So we'll see about that. So let's transition now to the Sioux Falls economy and talk specifically about real estate and about debt, because I think it's important we talk a little bit about the debt structure in our country. Right now, on average, there's all about $2.5 trillion of outstanding debt. That's about our average that we've had over the last decade or so. What this shows you is maturity of that debt in length of time. And what I want you to focus on is that 2017, 2018, 2019. And look at how much of that debt it lowered, and look how much got pushed out for 10 years. What you're seeing is debt is so cheap that debt's cheaper than equity. So you're seeing more and more debt being placed on real estate and less equity. And as a result of that, you're seeing people take out debt for a longer period of time, 10 years in most cases, and they're pushing that out. That's not all bad, but it could create some bubbles at the end of that tunnel. A better slide is the next slide that I want to show you. This really shows you not by maturity date, but by who issues that debt. And you can see commercial real estate and multifamily real estate, for the most part, is controlled by local banks and thrifts, about 50% of it. Ironically, I told you earlier, the average is about $2.5 trillion. We're now $3.5 trillion, and that's, I think, in 4 short years. So you're seeing more debt being taken out on institutional properties and local properties. So you're seeing that debt as an alternative. How does that portray and play itself out in Sioux Falls? I think you're going to see larger scale projects get announced. Sioux Steel's a perfect example, $190 million project that got announced here. They've got a lot of issues to work through, and they'll work through them. But the point is you're going to see larger scale projects, more thought out projects with larger debt structures right here in Sioux Falls even. So something to think about as we move into this decade. Let's transition again to jobs, because I think jobs really drive the real estate market here. And I always like to start with the federal level and see what they're doing and then kind of relate it to our level. You know, we topped out with about 2.2 million jobs last year at the federal level. Robust, not a record, but pretty darn close to a record. And so you can see a nice run up of those jobs last year. How did the state of South Dakota do? Well, you can see after several down years, I should point out that these numbers are non-ag numbers, but you can see the impact of ag on the state of South Dakota in those numbers the last several years. Now you're starting to see a rebound. We created 8,400 new jobs in the state of South Dakota last year, a nice 1.9% job growth. Now let's look at Sioux Falls. So you can see a really solid year for job growth for our community. Isn't it ironic that Sioux Falls, within the city limits, is 20% of the total population of the state of South Dakota, and yet we deliver 50% of the jobs in our state? I think that's going to continue through this decade, and I think it's going to continue to grow and grow and grow. I'll make some predictions about our job growth at the end when I wrap up. Well, jobs actually, as we know, drive real estate and construction. So let's take a look at our total building permits. And you may have already heard, it wasn't quite a record last year. We topped out at about $771 million in total construction, just slightly off from a record of the year before. What I want to point out, though, is in order to have that kind of robust construction, usually commercial is about 2/3 and residential is about 1/3. There's always 1 or 2 big projects on the commercial side that really buoy up that number and make it probably artificially a little higher than the reality is. And this year was no different, so let's look at that now. What you see is, on the left-hand side of that slide, some examples of the major projects. And what I want you to draw your attention to is the high school, Jefferson High, Ben Rifle Middle School, 2 school district projects, and then look at the water treatment plant. And you add all that up, $125 million in 3 projects alone really made that number probably stronger than it should be this year. And I think this other slide will show you why that is when you look at new construction. I skipped that earlier, so let me show that to you. Look at every one of these categories and look at how they're all on a downward trend. The multifamily's off 77% in 2 years. Office is off 55% in 1 year. Retail's off 50%. Even industrial, the steady Eddie industry of our industry, is off about 30%. And so what you're seeing is a downward trend of all of them, except that one, the other, and then that's fast forward again back to that next slide, and that's where you're seeing those examples that really make up that other category. The right-hand side of this chart, though, is what I want you to focus on, because we always look at the relationship between new construction and addition remodel. If we're in an expanding economy, new construction will outpace addition remodel, usually a 2-to-1 ratio, and you can see that gap continues to widen. So if we're in a contracting economy, you're going to see addition remodel, people pulling back, just remodeling, making small additions versus new construction. So this tells me 2020 is going to be another solid year for construction going forward. And we'll see, next slide, we'll see what our predictions are going to be here in the next couple of slides. So now let's transition to a look at how we stand from a regional standpoint. We always like to look at it in relation to our peer group in the upper Midwest. And you know, we don't show Minneapolis and some of the larger ones, but we'd like to see how we stand. Ironically, I always draw my attention to Rochester. Rochester, as we know, has the Mayo Clinic, usually one or two really large scale medical projects, but yet they must permit like crazy because they're like 3 times the number of permits that everybody does. So I'm not sure what's going on in Rochester. But nonetheless, you look at our relationship to these other peer groups, we're doing great comparatively speaking. Okay, transitioning to some predictions, and then we're going to bring up the rest of the crew here to break down each segment of the market now. You know, there's going to be additional disruption. What that means in your business, I'm not sure. But what it means in our business is probably more and more debt. It means more and more pressure to make decisions based on that debt. And so I just think we're going to see more and more disruption going forward here right in Sioux Falls and certainly at a national level, certainly in 2020 on our election year. So we're going to see strong employment growth again. I think our biggest issue with employment is our workforce development. No question, we're being held back. I think our numbers last year would have been stronger, and our numbers this year would be even better if we had a comprehensive immigration plan and a workforce development plan. I know at a local level we're working tirelessly through Forward Sioux Falls and the Development Foundation and the Chamber to figure out more and more about our workforce development. So I applaud the efforts that we're doing as a community to do that because it's holding us back. And yet we're going to still see strong employment. I should point out that a lot of that growth the last couple years has been in trades. We had about an 8% growth in construction and trades last year alone. And in healthcare, we had about a 5.5% growth in healthcare. Noticeably absent last year and the year before was financial services, which has always been a driver of our growth. So it remains to see kind of where we play out, but growth in employment will drive those construction numbers. They always do. And I think you're going to see a fairly stable commercial construction year, but I think where you're going to see some interest and some uptick is in the residential side. You're going to hear from Nick and others about what they predict about that on the multifamily side as well. So with that, I'm going to bring up one of the new faces, and I want you to give a nice welcome to Bradyn Neises, who's going to report on the land market next.
Well, thank you, Michael, and good morning, everybody. My name's Bradyn Neises, and I'll be presenting on the land. We always start our presentation discussing the unimproved land transactions. These are large tracts of agricultural land purchased for the intent of development. Let's take a look at the scoreboard for unimproved land. Last year we had 7 transactions, which was good number, one above 2018, and just one off the pace of our historic high. Where did these transactions take place? On the map, you can see the colored pins representing our historic transactions dating back to 2012, and highlighted in the white boxes were last year's transactions. You can see it stayed true to the trend of that horseshoe growth around Sioux Falls with West, East, and South Sioux Falls. Let's break it down to each section and talk about them in a little further detail. West Sioux Falls, we saw one transaction, about 42 acres for $32,000 an acre. That happened near the intersection of 12th and T. Ellis. What does West Side look like next year? Well, with the limited amount of sewability, we'll see slower growth happening on the west side. But the city of Sioux Falls is in the planning stages of looking at a west side trunk line. That could be online in the next 5 to 6 years. But we'll make a note, we're going to keep an eye on the new high school and how that really spurs growth in that northwest section of Sioux Falls. Let's jump to the east side. We had 3 transactions. Starting at the bottom, we had about 60 acres purchased between Sycamore and Highway 100, just south of 57th Street. Jumping a few miles east on 57th Street near the river, 110 acres purchased for $24,000 an acre. And finally, 100 acres purchased just east of Dolly Farms along Highway 42. That sold for about $47,000 an acre. What does East Side look like next year? Well, with the availability of sewer and Highway 100 finally connecting into I-90, creating ease of access in and out of East Side Sioux Falls, we'll see steady growth happening on the east side. You could see 3 more transactions next year. Let's head south to South Sioux Falls, or what I might say, North Harrisburg. First, starting on your left, we got 32 acres purchased for $43,000 an acre. That happened near the T Airport, and that'll be mainly industrial development. But what I want to focus on is that red star, which represents the new elementary school, right across from Baker Crossing Golf Course. 2 transactions, both about 40 acres, at $17,000 and $22,000 an acre. Now, those are speculative price points with the anticipation of sewer service coming to this area. Who's bringing that sewer service? Harrisburg. As we reported last year, Harrisburg passed a bond to build a new elementary school, highlighted in the red, and new west side trunk line, highlighted in green. That trunk line would open up service to about 600 to 800 acres. But Harrisburg took a step back, and they got a little bit more aggressive, and they redesigned their concept plan to their new concept plan, highlighted in the yellow. You can see it goes further west, capturing almost all of Baker Crossing Golf Course, and further north all the way to 106, capturing the south side of the intersection of 106 and Louise Avenue. All in all, that highlighted area is about 1,500 acres, double the amount of their original concept plan. So what does this look like next year? Well, we'll see developers really paying a close attention to this area with the elementary coming online and that trunk line getting installed. And over the next decade, what does it look like? Well, Harrisburg is going to continue to make moves just like this to grow south or grow north into South Sioux Falls rather than Sioux Falls growing south. Let's move on to improved land transactions. Once that developer purchases that bulk land, they add infrastructure. They do the dirt work, they add curb and gutter and streets, and the utilities and the water, and they break that large tract down to smaller parcels and sell it on a per square foot basis. Let's take a look at the scoreboard for improved land. You can see 2019 wasn't a great year. We had less than half the transactions from the previous year, just under 30, and their sales volume dropped nearly $30 million. When we see this data, we got to ask ourselves, is this a leading indicator for what's to come for Sioux Falls? Well, let's look at a little bit more data and see if we can see a trend happening. In this graph, we break down the number of transactions into the different asset classes. I first want to point out that red arrow, or the red bar, which represents our retail and commercial. It's no secret, there was a large decline in retail sales. It's no secret that retail is changing, and Rob Kurtenbach's going to talk about it in his presentation, but with retail being our highest dollar per square foot, that helps explain a large portion of that decline in our sales volume. And looking at the other ones, they're all down, but just not as significantly as the retail. Let's take a look at pricing. You can see on the graph, there's a large spread between the low and the high, especially in that retail and that office, which is primarily due to the sensitivity to location. What I want to focus on is that mean from 2018 to 2019. You can see across all asset classes that they're all up. Retail, almost $2 a square foot. Office, $1.60. Our industrial, 60 cents. So what does this mean? Well, what we're seeing is when business owners are ready to make a move, they're going out and doing the research on getting pricing on land and pricing on new construction, and they're taking a step back and not moving forward with that project. If we reflect back on Michael's presentation on new construction, he pointed out all these asset classes are trending down. So what are those business owners doing? Well, one of two things. They're either just holding on, waiting for a better deal, or they're looking at existing properties. What I encourage you to pay attention to throughout the rest of the presentation, look at the sales volume for the rest of our different asset classes. You'll see they're all trending up a little bit. Which is something we'll keep an eye on in 2020. Let's move on to predictions. Unimproved land will stay steady, close to that 7 mark. Improved land sales, 2019 was a down year. I think 2020 will rebound. Starting with industrial, we'll be up. Hearing a lot of good activity happening in Foundation Park, and more availability of land happening down in T and over in Brandon. So industrial, we'll see it up. Retail, it's going to stay flat at that low mark, primarily due to large projects coming online and not taking a land transaction. You got Sioux Steel, the Sioux Falls Ford redevelopment site, which we're going to be really attracting those retailers. Office traditionally has been steady, so with a down year last year, I predict it's going to be a slight uptick this year. Multifamily, we had 2 transactions last year. I think it's safe to say we'll be a little bit higher going into 2020. And finally, infill sites. We saw one last year near the intersection of 41st and Minnesota, the old TMA building that was raised to make room for neighborhood dental. I think with some old, tired buildings along some major arterial streets, I think we'll see developers really looking at those at redevelopment sites rather than buying land. That concludes my presentation. With that, I'll introduce Reggie Kuipers to present on the office market. Thank you.
Thank you, Bradyn. As he stated, my name is Reggie Kuipers. I will be presenting on the office sector today. Before we dive into the numbers, I want to talk about some trends, national trends, global trends that are going to affect us in Sioux Falls today and moving forward. Some European countries and Japan have started to implement a 4-day work week. I'd look for that trend to continue. Additionally, watch for companies to continue to expand their remote and their flex work scheduling. And on top of that, as the millennials and the Gen Zs continue to enter the workforce, they're going to desire freedom and flexibility. And the employers are saying, you know what, we're okay with 1099 independent contractors because we don't want to pay your health insurance anyway. And because of those top 3, we're seeing continued densification of office. More people, less space. And on a side note, we're seeing a widely accepted relaxed wardrobe. Speaking of disruption or destruction, I don't know if the Vikings are going to win the Super Bowl, but I think we're going to see Bender in some Lululemon dress pants in the office real soon. I think so. All right, let's look at the numbers. Total office market in Sioux Falls is about 8.1 million square feet. At the beginning of the year, and we started looking at this research, I would have guessed that our vacancy rate would have gone up. Office kind of feels sleepy, but I would have been wrong. It's year over year. Last year, 2018 year end, we were at 11.5% vacancy. And then 2019 year end, we were under 10%. Office is starting to feel healthier. We had 4,200 new jobs. So we put those people, and we absorbed a lot of space. We put those people and filled up a lot of vacant office space last year without adding much new supply. Leasing rates, they held pretty steady. The Class A, the newer office, did tick up a little bit, absorbing some of that new construction pricing. And office sales, we had 30 transactions, 30 office buildings sold last year for about $34 million. Let's look at those real quick. Year over year from 2018 to 2019. 2018, we had 25 office sales for about $20 million. And in 19, we had 30 transactions for about $34 million. 5 more transactions, $15 million more in sales volume. Well, what gives? We had 2 outliers. The top building you see there is the Esurance property. That sold as an investment sale last year, and Nick's going to highlight that in his investment report in just a few minutes. The bottom property is the old TCF call center on Carolyn Avenue. That sold in June of last year to the state of South Dakota. It is now home for the School for the Deaf and several state agencies. Both of those properties sold for more than $5 million, which is what spiked that sales volume. Now we're going to transition and look at downtown. One cool note about downtown, when I moved back to Sioux Falls 10 years ago, downtown was simply downtown. In 10 short years, we've added 2 submarkets to our downtown. When somebody calls and asks about office space today, I have to ask them, do you have a preference, downtown, uptown, or East Bank? It goes to show you the vibrancy and the robustness and the demand to be downtown. Let's look at the numbers. 2.3 million square feet of tenant-occupied space downtown. Big picture on the vacancy. Feels really good to own an office building. We're at 5.5% vacancy. We absorbed some space last year, asking lease rates. Class A space is in that $18 to $20 a square foot. I want you to take note of that because with some new construction downtown, we're going to see that Class A number skyrocket next year. we're going to see downtown office in that mid to high 20s a square foot. Now let's look at vacancy a step further. I want to draw your attention to that Class A, that blue bar. 4 consecutive years we've been under 5%. I had to ask myself, why? Did you know that the last multi-tenant, multi-story office building constructed in downtown was the CNA building? That was in 2012, folks. 8 years ago. It's time for some new office space downtown. Now let's look at the suburban sector. About 5.8 million square feet. We added about 100,000 square feet to this sector last year. The vacancy rates, I'll break those down in the next slide. And the asking lease rates, Class A ticked up just a little bit with some of that new construction. That B and C actually went down a little bit. Now let's take a look at that, the vacancy. Class A, under 7%, we're about 6.1%, I believe. So not only are we going to see new construction downtown, we're also going to see some new construction on the south end. I'd look for another multi-story, multi-tenant office building constructed on the south part of Sioux Falls as well. Now I want you to draw your attention to the red bar, that Class B and C office, that second and third generation. 2020 is probably the get real year for some of these landlords or owners of these buildings. In my mind, you have 3 options, especially if you have a lot of vacancy. It's time to sell that building to an owner-occupant. It's time to take on some of that cheap debt and reinvest in that building to attract some tenants, or it's time to offer some considerable concessions to fill up that vacancy. Some conclusions and predictions in the office sector. We're going to see a lot of new construction in office. Some really cool projects going to be announced in 2020. But construction pricing is up, and those lease rates are going to skyrocket, especially downtown. Sales transactions should hold pretty firm. Let's look at the real estate cycle. You can see where we were in 2018. We were in hyper supply, but it's really difficult for us to have some recessionary pressures if we don't build new office. And last year we had decreasing vacancy, we had great job growth, and I think that we're entering into a recovery period in the office sector, but I would look for us to go into hyper supply as we go on into 2020 and probably have at a market peak in the next 12 to 18 months. And with that, I'd wrap up my presentation and present, I'd like to introduce Rob Kurtenbach to present on the retail market. Thank you.
Well, thank you, Reggie. Again, my name is Rob Kurtenbach. I'll be presenting on the retail market. And we're going to break it down kind of in 3 different ways. We'll talk online retail, we'll talk national retail, primarily just the big box transformation that continues to happen, and then we'll spend the majority of our time on the local market. So let's get started and talk about the online retail market. And I'm going to state one of the more obvious facts you're going to hear from any of us this morning, but Amazon has completely changed the retail game. They've disrupted it so much so that buying is so simple and that we've started to expect next day or 2-day delivery, whereas that used to be a luxury. And I think it's also important for us to understand how big is the online retail market. Well, it accounts for about 12% of the overall retail market. But an interesting stat, if you dive a little deeper into that, is the merchandise sales. And in 2019, for the first time ever, online sales surpassed brick and mortar merchandise sales. So that's an interesting trend to watch, and I think that'll continue to happen as online trends upward. Well, let's talk market share. Who does control the market when it comes to online? I think we all would have guessed this. It's clearly Amazon, and I think it will continue to be that way for a while. Last year, we reported that Walmart was making a pretty big push to gain some of that market share, and so they spent several $1 billion last year to get some of that market share. They went from 4% to 4.6%. So if you want to know what a couple $1 billion will get you, 0.6% of the online market share. So very interesting. And I think this will be a vicious battle between these retailers to gain more and more market share. As we all know, online retail is not some trend that's going to go away. It's here to stay. It really is the new normal. Let's take a look at national, and we're going to talk again just primarily big box transformations. A couple of examples up there on the left side of your screen. That's a former Lowe's that was converted into a church down in Kansas. On the right side, you have a former Kmart that was converted into a Catholic high school in Illinois, and so just some interesting creative ways that we're getting creative in how we're transforming these big footprints that these national retailers are leaving when they vacate those properties. Locally, we've had a couple of those that we all probably are aware of. Stan Houston on West 12th Street is now up and running and has been for a little while in the former Kmart. And then more recently is the At Home store along 41st Street in the former Shopko that is also up and running as well. So two notes that I want to say on East 10th Street that we're going to see as some additional transformations is the East Side Kmart and the East Side Shopko. Both of those properties are currently under contract, so be looking for some pretty big announcements in 2020 as we transform those spaces. Lastly, on the national side, if you didn't hear earlier this month, Macy's announced that they're closing 125 stores nationwide. It sounds as if the Sioux Falls store will remain open, but I think it's just worth noting that this big box transformation probably is not over, and are more announcements going to come with Macy's or other retailers, as recently happened with Pier 1? Time will tell on that. Well, let's take a look at the local retail market, and we're going to talk specifically on the vacancy rates first. One thing I want to point out is the price points that you see on these, the price range that you see on these does include Class A, B, and C. Retail space, so that's why you see a pretty big gap in those numbers, and so just wanted to point that out, and I'm just going to focus on two of these bubbles that are up there. First off, the East Sioux Falls one, 32% vacancy. That's not good, but when we look a little bit more into that, that does include about 200,000 square feet of that East Side Kmart and East Side Shopko. So if you pull that 200,000 square feet out, it's actually closer to 7%. So East Sioux Falls is actually in a really healthy spot when it comes to vacancy, but it looks not as healthy when you see it as is with those two big box stores included. Secondly, I want to talk about 41st Street. We've mentioned this in years past, and I think it's worth noting again. 41st Street used to be kind of where it was at if you were in the retail world, and certainly there still is some viable retailers there, but it is changing, and I think it's worth noting what some of those changes are. And so what's happening on 41st Street? Well, as I started researching into that, traffic counts was something that I really wanted to kind of dig a little deeper into. And as we look at traffic counts on 41st Street, it's really interesting to see the decline that's happened on 41st Street when it comes to traffic counts. And primarily, I want you to focus on between Louise Avenue and Kiwanis. Go back to 2015, that was the highest traffic count out of anywhere in the city of Sioux Falls. If you fast forward to 2019, it's not even in the top 10. And so there's been a drastic decline in traffic counts along 41st Street, which may explain why some of these retailers have been struggling to stay open, and we've seen an increase in vacancy rate. Well, where are these people coming? If they're not coming on 41st Street, is it that they're not coming, or is it a change of how they're getting there? I think it's a little bit more of changing how they get there. If you see on the screen here, to the north and to the south, we've actually seen an uptick in traffic counts, and I think that's partially because you got Lake Lorraine on the west side of the interstate, so you got shoppers coming from that side over, and they're just taking Louise Avenue and going down. They're avoiding 41st Street and I-29, so instead of coming that way, they're staying on Louise Avenue, and I think on the south side, you're seeing the same thing. Instead of coming around to get off on I-29 and 41st Street, they're just coming down Louise Avenue. So I think overall, yes, we're seeing a decrease, but I think we're also seeing a different pattern of how people are getting there. We've also mentioned this in the past, and I think 41st Street is a good example of this, but if you're a retailer and you're not providing some sort of an experience, some sort of a discount, or some sort of convenience for them to come there, why would we not just click buy now on Amazon? And I think that's something that they really have to wrestle with. And I think we'll continue to see 41st Street feel some pressure until some of these retailers really evaluate their concepts that they're doing and seeing if they can find a way to get people to come to their store. And I also want to note that there's some added pressure when you have a Lake Lorraine and a Dolly Farms and some other ones that are going to come online soon. It's created more and more pressure for these 41st Street retailers to get creative in how they're attracting customers. Well, let's take a look at retail property sales. We had a solid year, a little bit of an uptick from 2018. So 2019, we had about 60 million in property sales. And I think we're going to probably see a pretty similar number in 2020. It's looking pretty good for 2020. A couple notable sales was River Plaza on the west side. That'd be kind of by Century Theaters, where Ruby Tuesdays is. That strip mall sold in 2019 to a different investment group. Another notable sale is the former CJ Callaway's, now is Looks Marketplace. Those are some of the bigger transactions that happened in 2019. And like I said, I think we're going to see pretty similar numbers here in 2020. All right, well, let's take a look at some trends that are happening. This first one's pretty fascinating. Gen Z, which would be today's teenagers, they are actually making a pretty big push to go back into bricks and mortar stores. In fact, in a recent survey, 81% of them preferred to shop inside a store versus online. Now, I want to just note with that, they maybe liked the experience of going with their friends to the mall, and I think it'll be interesting to see as they get a little bit older and they have to make the decision to drag their 3 children through the retail store or click buy now on Amazon. I'll just leave it at that, so time will tell. We'll keep an eye on that one. Food delivery is another one that's really fascinating. That industry has exploded over the last several years. It's now a $10 billion a year industry, and it's just, we're not just ordering pizza with delivery anymore. We're ordering food from every kind of restaurant that there is, and so I think we're going to continue to see that drastically increase over the next few years. And in fact, in 2020, some of the predictions are that we'll see restaurants sell more food that is consumed outside of their store than food that is consumed inside of their store. So that'll be, again, an interesting trend we'll keep an eye on. Next I want to touch on, is that customer experience is your brand. And I'm going to say it one more time to let that phrase sink in. Customer experience is your brand. It's no longer about just having this nice logo, a cool website, and a pretty nice building. It really comes down to your customer experience, your customer's experience, and that's what they're taking away as your brand. And so I think it's really important that we kind of let that sit in and kind of understand what our retail customers are experiencing when they come to our stores. Next, I want to touch on customer service. We're seeing an uptick in retailers hiring more experienced employees, and I think that will continue to happen. And also with customer service, I want to talk about one company in particular that consistently gets top reviews in the fast food industry, and that's Chick-fil-A. And Chick-fil-A is known for the experience that you get when you go there. They, like I said, continuously are at the top of those reviews, and they focus big time on their staffing. They focus big time on who they're going to hire and where's their best fit. And they also spend the most money than any other fast food restaurant in the industry on training their employees. Why do they do that, and is it working? Well, let's take a look if it's working. They have less than 2,000 stores open nationwide. I wish I was here to tell you that they're coming here. I don't know that, but they need to make 2001 here in Sioux Falls. But anyways, they have less than 2,000 stores open nationwide, and that's half of the stores that Taco Bell and KFC have, which would be 2 of their competitors. Yet Chick-fil-A has more sales than both of those, and I might add that they're open 1 less day a week less. So very fascinating, and why is that happening, or how are they getting that? Chick-fil-A understands that it's more than just enjoying their delicious chicken sandwich. It's about the experience that you have before, during, and after. All right, let's take a look at some predictions. I think we're going to have a really exciting year here in 2020. There's 3 particular developments that I want to mention and have been mentioned here before, but Sioux Steel downtown is kind of a niche retail. I think that's going to be a really exciting project for downtown Sioux Falls. Gage Brothers, which would be along I-29 and 12th Street, that's going to be a bit more of a junior box development, maybe a little more similar to a Lake Lorraine. And then also the redevelopment of the Sioux Falls Ford, which if you didn't hear, Chipotle was announced a day or 2 ago that's where they're going to be going. And I think with these developments, you're going to see a lot more national retailers being announced to come to these locations or other various locations in Sioux Falls, which is exciting for us. And why are we getting more national retailers? Yes, we have some great developments that they can be a part of, but I think we're also seeing us hit some benchmarks as a city. That's certainly happening, but I think more than anything, It's these corporate offices pushing sales across the country, and they want more and more operations to be open. And so it's created an opportunity for a market like Sioux Falls, and they're really starting these smaller market concepts. And Dave & Buster's out at Lake Lorraine is a prime example of that. It's a perfect example. They've shrunk their footprint, but they're going to give you the same Dave & Buster's experience when you show up. And I think we're going to see more and more national retailers kind of come up with these smaller concepts, small market concepts, and we'll see a lot of those announcements coming here in Sioux Falls. Well, where are we at in the real estate cycle? Well, we've kind of been in this expansion and hyper supply range for the last couple of years, and kind of similar to what Reggie mentioned in the office market, retail does tend to fluctuate a little bit quicker, and I think honestly we've kind of went right past recession and we're right into this recovery and expansion phase again. I think we'll go more and more into expansion over the next couple of years, and I think that's largely driven just by the demand that we have. We live in a really great city with a great economy, and I think that's the reason that we've kind of been able to just jump right past this recession phase, and we're going right back into recovery and expansion. That's all I have for my presentation. I want to invite Rob Fagnan to present on the industrial market.
Well, I already got a couple questions this morning about this thing right here that I'm holding. And if you were with us last year, you know we had a couple little hiccups with this. And Bender gave us so much crap over the past year about us sitting up here clicking that I thought I'd give a second go at it. Nick and Reggie decided to wuss out. So I've checked the settings on this thing like 5 times before coming up here, so hopefully it works. But anyway, thanks, Rob. Great job, by the way. You're so pretty up here. 2020, here we are. New decade, and I think it's going to be a decade that has a major impact on industry as a whole. We're going to see large-scale data centers pop up all over the country to keep up with the growing demand for cloud storage, blockchain technology, 5G, you heard Michael talk about that, and quantum computing, which is a new term that a lot of people haven't heard of yet. Others will include mega warehouses popping up. And we've actually received word recently that there's a pretty large project that's looking here in Sioux Falls. But we'll see if that comes to fruition. Multi-story distribution facilities in large urban areas as well. And that's all to keep up with this growing e-commerce world. Robotics, automation will become a standard in manufacturing, and long-haul driverless trucks will bridge the gap between the shortage of truck drivers and the need for same-day delivery. Now, it's all these behind-the-scenes industries that I like to refer to as our industrial universe. So let's break that down on a local level. I wanted to take a look over the past decade to see how far our universe has come. As you can see, we've had about a 75% increase from 14 million up to 25 million square feet. Now, I also want to highlight back in 2010, that 4.63% vacancy that you see there, that's the highest vacancy our market has seen in our 20 plus years of doing this research. And it's where the national average is at today. So Sioux Falls is sitting in a pretty good situation as far as our vacancy. Okay, if you've been with us in the past, we always like to track the difference between owner-occupied space, the orange slice of the pie there, and tenant-occupied space, the red slice of the pie. And it's no surprise owners have dominated our market for a very long time. However, that trend's starting to shift a little bit as we continue to see more and more regional and national tenants come to our market. They don't want to own their own property. They want to rent. And so that's why we're seeing that uptick from 24% up to 31% on that end. Now, everybody in the office every year asks me, Rob, remind me, what's the importance of this slide? So if I have to remind them, I assume I'm going to have to remind you why it's important. And I'll just keep it real simple. Number one, if you're a seller, you're looking to sell your property, there's a pretty good chance that you're going to get it sold because you're appealing to about 65% of the market. Now, if you're a landlord and you're sitting on some vacant space, you got to try to get creative in how you're going to backfill that space. And that can be things such as discounted rent, free rent, or adding some amenities to your property to differentiate yourself from your competitors. So those are two key reasons why it's important to track this information. Okay, let's take a look at new construction. Coincidentally enough, over the past 2 years, we've had two 11% drops. Now, I'm not too concerned about that because it's still the third highest the industrial market has seen as for new construction. Of that 615,000 square feet that got constructed, more than half of it was tied up in these two buildings. The one on the left, might I add, it's the first spec building Sioux Falls has seen over 100,000 square feet, sitting at 120,000. This was built by a Fargo developer who took a chance this past year and has already filled up about half of the building. This is located up along East 60th Street North across from the old Citibank campus. And the one on the right is a long-standing company here in town, Nordica Warehouses, built a 200,000 square footer in Sioux Falls Development Foundation Park up along the intersection of I-29 and I-90. Now, why are we seeing a tapering off of some of this new construction? Bradyn kind of stole my thunder a little bit and led into it, but we are seeing a drop in land prices or not land prices, drop in land transactions. And when business owners are going out, they're still getting sticker shock. Some of them business is so good they need to go construct and expand their new buildings. But there's some business owners that have decided to kind of hold back on that new construction. And one of the things that they're doing, and we can see it on this next slide, is 2 consecutive years of an increase in existing building sales, topping out at about 50 total transactions this past year that equated to $63 million in total dollars spent. Some additional stats, net absorption and vacancy rate, the two kind of go hand in hand. Typically, when we see a rise in absorption, vacancy drops slightly and vice versa. As far as rental rates, we haven't seen a whole lot of rental rate growth over the last 3 to 5 years. I noted last year that we saw about a 50-cent per square foot increase in that Class A space, but for 2020, we're more than likely going to be hovering right around these same ranges. Okay, before I get into my conclusions and the real estate cycle, I wanted to highlight 2 big trends that we're seeing nationwide. And one is an emerging trend, the other is a re-emerging trend. And I'll bring that down to how it affects us on a local level. The first one being reverse logistics. A lot of people have never heard this term. Simply put, it's the process of returning a product. You heard Rob talk about customer experience and how important that is. Well, what companies are doing is on the logistics side, they are providing people with prepaid packaging that they ship along with their product to make it very easy to return that product if they need to. Here's a little interesting tidbit of information. UPS estimated in 2019, over the holiday season, 1 in 3 packages were returned. Think about that. 1 in 3 packages. So a whole entire industry is being created around e-commerce and the need to have that customer experience. So pretty fascinating. How does it affect us on a local level? Well, the beneficiaries of this are companies such as XPO Logistics, Ryder, UPS, and others. Many people don't track this, but several of those companies have either added on to their facilities here in town over the past several years or went out and built new. So over the next decade, I think we're going to see a huge uptick to service this new industry. All right, the next one, and this one's reemerging, is rail. You know, with the shortage of truck drivers, that we've talked about over this past year, and improved efficiencies within the rail industry, shippers are looking to rail as a viable alternative to long-haul trucking. As far as cost of freight, the general rule of thumb is 1 cent per ton for barge, 10 cents per ton for rail, and $1 a ton for truck. Now, those are pretty fascinating numbers when you think about it. And unless we're going to be drudging through the Big Sioux anytime soon here, we're probably not going to be taking advantage of that barge rate. So the next best thing is rail. And thankfully, you know, for several years, we have had a huge lack of rail serve sites in and around Sioux Falls. And with the investment that the Sioux Falls Development Foundation and its partners made to go up and create Foundation Park, along with Bradyn and other area communities, we've opened up hundreds of acres to rail serve sites. So I think we're going to look back 10 years from now and say that the investment made in all those areas was well worth it. So watch for that industry to grow over the next decade. Okay, on to the real estate cycle. I wanted to take a look at kind of where we've been over the past 10 years. And Reggie said it best just a week ago. He said, man, the industrial market is just the turtle in the race. And he's right. You know, it's the slow and steady sector of our overall market here locally. And as far as 2019, we had 3 bullet points in expansion and 3 bullet points in hyper supply. So I decided to put us right up at the peak there again, just like we were at in 2018. With some of the projects that are being discussed for 2020 and 2021, we may push over just slightly into hyper supply for 2020. So with that, I would like to bring up our home run hitter here, Mr. Gustafson, to present on the investment market.
Thanks, Rob. In this portion of our presentation, we focus on investment properties. And my goal today is to help Sioux Falls investors make informed decisions in 2020. And to do that, we're going to take a look at some macro trends on a national level. We'll take a look at some Sioux Falls trends, and we're really going to drill down into individual deals and cap rates so we can make informed predictions about 2020. Investors buy real estate for typically 3 reasons: appreciation, yield, and the favorable treatment by the IRS of the asset class, favorable tax treatment. However, as investors ourselves, we know that a well-balanced portfolio has more than just commercial real estate in it, right? Several asset classes that compete with real estate: equities, bonds, primary businesses, and of course, the occasional case of first growth Bordeaux. Now, it's no surprise to anyone sitting in this audience that major equity indexes and some commodities had a monster year in 2019. These are big numbers. However, if you recall your last 2018 statements that you got from your broker, many of these equity indexes had a negative year, worth remembering. We are in year 10 of an unprecedented bull market in real estate. Many of our clients are taking a hard look at their portfolios and seeing a significant amount of appreciation. What they're doing in some of these cases are deciding it's time to sell at a peak, if not the peak, and they're taking money off the table, or they're 1031 exchanging into new larger assets. Now, buyers are actually making some pretty smart decisions here. They're taking low cost, long-term debt, and they're placing it on fundamentally sound assets: office buildings, retail buildings, apartment buildings. So things are looking pretty good for buyers and sellers. We're going to take a look at a couple of macro slides here. Now, there's going to be a lot of information, and we're going to hit just a couple of takeaways, and you'll notice all these slides are showing signs of health. This first slide is U.S. investment real estate sales going all the way back to 2001. The two takeaways that we want to take from this slide is 2019 was a monster year. In fact, it was the third highest year in terms of sales on record. That's great. The second takeaway is you can almost see two entire market cycles going back to 2001. The run-up to 2007, the previous peak, that really rough trough, if you guys remember, 2009, 2010, and the sustained healthy bull market that we've seen over the last 10 years. This is a healthy slide. Next up, another thing we'd like to take a look at is how much capital is out there ready to invest in real estate. This is a national slide, and it's showing in 2019, there was almost $200 billion worth of capital that was raised but not invested, waiting for the right real estate deal. This is also a sign of strength. Next up, we see the U.S. investment real estate appreciation slide. This tracks all the way back to 1998. This is benchmarks at 2007 price points. And the two takeaways from this slide is, number one, we're about 35% over the previous peak in 2007. However, we're roughly double from the trough in 2009 and 2010. Also a sign of health. Investors buy real estate because there's a big spread between safe harbor investments like 10-year treasuries and an office building or an apartment building. So this dark bar that you're seeing up here on the lower end, the dark green, that's the 10-year treasury. Notice how that's really gone down. Investors have had to take risk in assets like real estate to continue getting returns for their portfolios. So that was our national macro slides. Everything's looking pretty healthy. Let's drill down a little bit into some local slides. Now, we heard fundamentals on office, retail, industrial. We're going to take a couple moments here to really take a hard look at the Sioux Falls multifamily asset class. Now, since the recession in 2009, 2010, multifamily developers have built quite a few new multifamily units to keep up with the strong Sioux Falls population growth. However, this trend peaked in 2016 at about 1,600 units and has pulled back rather sharply. Why did this happen? Vacancy. As investors, or as these developers started building more and more units, 1,600 units in 2016, vacancy rates started responding. These developers noticed that their portfolios, these big new projects that you're seeing all over town, weren't filling up quite like they thought they were going to. So what they decided to do is let's pull back a little bit. And when they pulled back in a prudent and healthy manner, vacancy rates went down. And right now, we're just right above 8%, and this is a very healthy sign for the multifamily market. Next up, we're going to take a look at sales. And these are sales measured in volume on the bar, going back to 2006 all the way up to 2019. The number on the bar is the number of transactions 4 units and higher. 2019 was a monster year. Nearly $100 million worth of properties were sold. That's incredible, and it's 25% greater than the previous record that was set in 2018. This is also another sign of health. We're going to look at some individual deals, some individual cap rates, and over a couple of different asset classes now to really give the investors out there in the audience and their bankers a sense of yield. This is really a bellwether transaction. Whispering Woods. This was a $17 million transaction, and why it was so important, for a really long time in Sioux Falls, we didn't see anything close to something of this size at this age range, less than 10 years old trade, and this happened at a 6.1% cap rate. Next up is a really great contrast. This is a 50-year-old project. 1970 was 50 years ago, right? Which makes me think, wow, I'm 40. $7 million transaction at a 7.1% cap rate. Notice the spread between cap rates. You need a little more for an older property, and also there's a big difference between the price per unit. Hayden Point, this is up here not because of the cap rate, which was kind of low, but this was a typical or a classic value add transaction. An investor came in here, bought this, and is in the process of investing a lot of money in each one of these units to reposition the asset to get more rent. So this is more of a value-add deal. We're going to look at a couple of office caps now. This is a multi-building, multi-tenant development, relatively brand new, 5 to 7 years old, a 7.61% cap rate. The Esurance building sold last year. That's a single-tenant call center. Esurance, of course, is now owned by Allstate. Look at the cap rate. This is quite a bit higher than the other deals that you're seeing on the screen. This was because there was just a couple of years left on that lease. The investor needed a higher rate of return to compensate for some risk. About 3 years left on that. This is an early 90s office building, Western Valley Properties. There's a little bit of a warehouse component in the back here. This traded at a 7.61% cap rate. This is a really nice strip mall. This is just north of the new Walmart on the south side of town. $3 million deal, 6.91% cap rate. Caribou, East 10th Street, right across the street from Starbucks, of course. $1.3 million deal, a 6.73% cap rate. So in 2019, which was a big year, we saw investment sales go up in multifamily, office, and retail. And based on the fundamentals that we're looking at and talking to our clients here just in the first couple weeks of the year, we can confidently predict that we're going to see an increase in all three of these asset classes in 2020. Cap rates, on average, will be between 6.75 in multifamily and 7.5 in office and roughly 7% in retail. In conclusions, 2019 was a monster year. It was a record year. We're starting to see some cap rate compression, especially in multifamily. The deals that happened last year are showing significant asset appreciation across asset classes. The good news is while there was some froth in some of these deals, most of them are still feeling really solid, which gives us hope that we're at a peak, not the peak. Predictions, we've mentioned this before in the presentation, sellers are sensing a peak right now. And what that's going to prompt some people to do on some of their assets are to sell them. And they're going to take a profit, they're going to take money off the table, or they're going to do a 1031 exchange. They're going to buy a larger property and put some of this low-cost, long-term debt on a new asset. Prices are going to go up, and because interest rates continue to go down, it's not enough just to leave your money in a CD or a 10-year treasury. You have to go out there and take some risk in some elements of your portfolio, like real estate, to continue receiving yield or returns. We're going to kind of take a final look in conclusion of my presentation. Where are we at on the multifamily real estate cycle? Well, based on the fundamentals that we looked at, we're firmly in between recovery and expansion. With that, I'd like to bring Michael Bender up to conclude the presentation.
Thank you, Nick. Well, based on what you see, it looks like we're in for a good year here in our community in 2020. A couple closing thoughts. First, I want to just recognize our whole team. There's a lot of people that do a lot of research behind the scenes and analysis. But there's one person that does a lot of it, and that's Summer Hoffman. She's up in the booth. This is her 21st year of the Market Outlook. So I want to thank you, Summer, for being involved. Well done. To Bradyn and Rob, you're no longer Market Outlook rookies. Well done. So, and finally, it's been our desire for 23 years now to fulfill a promise that we made to you, the business community. And that promise is to be the most trusted name and a leader in providing you information, analysis, consulting services, and counsel on your commercial real estate needs. We're just hopeful that we can earn that trust and continue to gain that trust in 2020. So thank you very much. You are dismissed, and have a great day.